After studying this module, you shall be able to know about how the division of revenue is done between the center and states, understand the need for provisions for financial relation in the Constitution, assess the nature of financial relations between the center and states in India, understand the problems faced in proper distribution of funds between the center and states, analyze the significant measures that can be adopted for proper devolution of funds.
Financial relations are the most important aspect of center-state relations. No system of federation can be successful unless both the Union and the states have at their disposal adequate financial resources to enable them to discharge their respective responsibilities under the Constitution. The financial relations between the center and the state governments in countries adopting the federal system of government are defined by the distribution of powers. The Constitution makes a broader distinction between the power to levy a tax and the power to appropriate the proceeds of a tax. So, the legislature which levies a tax it is not necessarily the authority which retains the proceeds of a tax levied. The legislative power to make a law for imposing a tax is divided as between the Union and the state by means of specific entries in the Union and the state legislative lists in Schedule 8. Thus, while the state's legislature has the power to levy an estate duty in respect of agricultural lands, the power to levy an estate duty in respect of non-agricultural land belongs to the Parliament. Similarly, it is the state legislature which is competent to levy a tax on agricultural income, while the Parliament has the power to levy income tax on all incomes other than the agricultural income.
Let us discuss the nature of financial relations. Indian Constitution gives a detailed scheme of distribution of financial resources between the Union and states. Both the Union government and the states have been provided with independent sources of revenue. Center can levy taxes on the subjects included in the Union list. The states can levy taxes on the subjects in the state list. There are usually no taxes on the subjects in the concurrent list. In the financial sphere, the states are greatly dependent on the center for finances. The center can exercise control over state finances through the Comptroller and Auditor General of India and grants, but during financial emergency, the President has the power to suspend the provision regarding division of taxes between the center and the states. There can arise some special problems that need to be solved within the federal financial system in determining the basis of division and the amount that should be divided between the center and the state. One of the instruments which the Constitution has evolved for the purpose of distributing financial resources between the center and states is the Finance Commission. The Finance Commission, according to Article 280 of the Constitution, is constituted by the President once every 5 years. The duty of the Commission is to make recommendations to the President regarding distribution between the Union and the states of the net proceeds of the taxes which are to be divided between them, and the allocation between the states themselves of the respective share of such proceeds, principles which should govern the grants and aid of the revenues among the states out of the Consolidated Fund of India. According to the Finance Commission, statutory transfer of resources between the center and states takes place in three ways as share in taxes and duties, grants in aid, and loans. Various articles of the Constitution deal with distribution of the tax revenue, non-tax revenue, and grants and aid between the Union and states. Various articles of the Constitution deal with distribution of the tax revenue, non-tax revenue, and grants in aid between the Union and states. Let us discuss these topics individually. Tax revenue. Article 268 deals with duties to be levied by the Union but collected and appropriated by the states. It includes duties on medicinal and toilet preparations, excise on tobacco, corporation tax, customs and import duties, estate duty, terminal taxes on goods and passengers tax on goods for interstate trade, etc. Article 269 deals with taxes to be levied and collected by the Union but assigned to the states. It includes duties in respect of succession to property other than agricultural land, estate duty in respect of property other than agricultural land, terminal taxes on goods and passengers carried by rail, sea or air taxes on railway fares and freights, taxes on the sale and purchase of newspapers and advertisements given therein, etc. Article 270 deals with taxes to be levied and collected by the Union and distributed between the Union and the states. It includes tax on income other than agricultural. Article 272 deals with the taxes to be levied and collected by the Union and which may be distributed between the Union and the states. It includes certain items given in the Union list such as railways, post and telegraph, telephones and wireless, foreign loans, customs and export duties, foreign exchange, etc. Non-tax revenue. Sources of non-tax revenues for the Union are the receipts from railways, posts and telegraphs, broadcasting, opium, currency and mint, and industrial commercial undertakings of the central government relating to the subjects over which the Union has jurisdiction. Sources of non-tax revenues for the states are forests, irrigation, commercial enterprises, and industrial undertakings such as soap, sandalwood, iron and steel in Karnataka, paper in Madhya Pradesh, deep sea fishing and silk in West Bengal. Grants in aid, as tax and non-tax sources are not adequate for the states to carry out the development programs, so the Constitution provides that grants in aid shall be made in each year by the Union to such states as Parliament may determine to be in need of assistance, particularly for the promotion of welfare of tribal areas, including special grants to Assam. Article 275 deals with the grant and aid given by the Union to the states for implementing its planning programs as well as for the development of the scheduled castes, scheduled tribes, and other weaker sections of the community. It is provided that the President shall determine special grants to some states like Assam, Bihar, Orissa, and West Bengal in lieu of export duty on jute and jute products. Now let us discuss some of the special provisions included in our Constitution to safeguard the interests of the states in the Union, along with taxes which are divisible according to the foregoing provisions. It is provided by the Constitution, Article 274, that no bill or amendment which varies the rate of any tax or duty in which the states are interested or affects the principles on which money is distributed according to the foregoing provision of the Constitution or imposes any surcharge on any such tax or duty for the purposes of the Union shall be introduced or moved in Parliament except on the recommendations of the President.
If the President is satisfied that there is an economic situation in which financial stability or credit of India is threatened, he or she can declare financial emergency. Such an emergency must be approved by the Parliament within 2 months. In case of a financial emergency, the President can reduce the salaries of all government officials or employees, including judges of the Supreme Court and High Courts. All money bills passed by the state legislatures are submitted to the President for his approval. He can direct the state to observe certain principles, that is, the economy measures relating to financial matters. The phrase emergency period is used loosely when referring to the political history of India. It often refers to the third and the most controversial of the three occasions, but fundamental rights cannot be suspended.
Emergency provision. While a proclamation of emergency, Article 352(1) is in operation, the President may, by order, direct that for a period not extending beyond the expiration of the financial year in which the proclamation ceases to operate, all or any of the provisions relating to the divisions of the taxes between the Union and states and grants in aid shall be suspended. In an emergency situation, if the President makes any such order, the states will be left to their narrow resources from the revenues under the state list without any augmentation by contributions from the Union. In case of financial emergency, Article 360(1), if such an order is made by the President, it shall be competent for the Union to give directions to the states to observe such canons of financial propriety and other safeguards as may be specified in the directions, to reduce the salaries and allowances of all persons serving in connection with the affairs of the states, including High Court judges, to reserve for the consideration of the President all money and financial bills after they are passed by the legislature of the state. In addition to transfer of resources from the center to the states, according to the recommendations of the Finance Commission, there are two other sources of transfer. One, assistance for planned purposes from the Planning Commission. Two, discretionary grants from the center to the states. These sources of transfer have contributed substantially more resources than statutory transfers, which are transfers through the Finance Commission, and reflect the considerable power that the central government enjoys in influencing the decision-making process at the state level. For most of the period of planning, statutory transfers have remained less than one-third of total transfers. The remaining two-thirds have been contributed by the Planning Commission as assistance for planned purpose or by the central government as discretionary grants. Though the Planning Commission has no statutory basis as against the Finance Commission, it has tended to take up the functions of the Finance Commission and for a considerable period of planning has remained the more important source of transfer.
Money bills in India Parliament under the Indian Constitution. Article 110 of the Constitution stipulates that a bill in Parliament is to be deemed as a money bill if it relates to number 1, imposition, abolition, or alteration of any tax. Number 2, borrowing of money by the Government of India. Number 3, the custody of the Consolidated Fund and the Contingency Fund of India, the payment of monies into the withdrawal of money from such funds. Number 4, the appropriation of money out of the Consolidated Fund of India. Number 5, declaring any expenditure to be expenditure charged on the Consolidated Fund of India. Number 5, the audited accounts of the Union or any of the state under Article 110. It is clear that a bill is a money bill only if it relates to all or any of the 6 clauses specified in the article. If any question arises whether a bill is a money bill or not, the decision of the Speaker of the House of the Lok Sabha is final.
Now let us discuss the issues and problems associated with financial relations. A major problem faced in a system with multiple fiscal authorities is integration of financial policies, which is an objective in a planned economy. Moreover, problems arise due to the imbalance of financial resources between the center and the states. With considerable economic progress, the base of income tax, union excise duties, custom duties, and other important central taxes has expanded considerably. This has given immense powers to the central government to increase its resources with the passage of time. The revenue-raising capacity of the states is restricted by the nature of taxes assigned to them. For example, as land is limited, the scope of increasing land revenue is also limited. Further, taxes on agricultural income, excise duties on intoxicants, taxes on motor vehicles, entertainments, etc., are comparatively less elastic than the taxes assigned to the center. Sales tax is the only tax levied by the states which has substantial elasticity. The demands on states' resources are increasing rapidly because of the pressure of development policies, especially in the field of social welfare. However, their income has failed to increase correspondingly. Another problem for all the state governments is the shortage of financial sources Within the present structure of center-state relations, on one hand, the financial requirements of the states are vastly increasing, and on the other hand, the center has been gradually encroaching on financial powers and cornering for itself a major share of the total national resources. In the present scheme of resource distribution, the central government in India has more money than it needs. Most productive sources of revenue are with the center, while most expensive heads of expenditure are with the states. For example, the state governments are directly responsible for the maintenance of law and order and carrying on welfare activities such as education, healthcare, etc. Consequently, the states have less revenue incomes than they need. Plan assistance from center was meant to enable the state to undertake certain schemes according to plan priorities. In actual practice, however, the states are presented with a choice of schemes, each with predetermined proportions of loans and grants assistance. Also, there is no objective criterion to decide the distribution of non-statutory transfers, which has introduced an element of arbitrariness, as everything depends on what the center thinks about the needs of the states. Another problem has been the increasing indebtedness of the states to the center for various developmental purposes. The states find themselves unable to repay the installments or interests on the debts without further central assistance. The difference in levels of economic development leads to imbalance between different states in terms of income and wealth disparities. Such interstate imbalances are a perennial source of tension with the center.
So far, the total dispensation of fiscal transfers through the Finance Commission and plan allocations through Planning Commission have increased rather than narrowing down regional imbalances. And if this trend is to be checked, radical change in the pattern of financial assistance to the states is required. Plan assistance is provided 70% in the form of loans and 30% in the form of grants. Since the ratio is fixed and does not discriminate between advanced and the backward states, it amounts to discrimination against backward states. Since advanced states have a relatively better economic position, they should be granted a greater percentage of resources in the form of loans, while backward states should receive a larger percentage in the form of grants. Non-compliance to this common sense logic has resulted in a paradoxical situation where the comparatively richer states received a higher per capita grant than poorer states.
Now we will analyze some suggested measures to tackle the issues associated with financial relations. The scheme of financial relations between the Union and the states is flexible and adaptable to varying needs according to different situations. Resources and needs are reviewed periodically by the Finance Commission, which recommends the requisite changes. The Union and states are mutually dependent, and such coordinate nature has given stability to the working of the Indian Federation. The Finance Commission is required to do justice between the center and states and between different states and need to assure the states that they will have a fair deal. After the constitution of the Planning Commission, the Finance Commission's role in allocation of resources to states has been devalued to a great extent. The state governments generally prefer allocation of fiscal resources through the Finance Commission as it is a constitutionally mandated body, whereas the Planning Commission is a creation of the Union government through an ordinary executive order. The scope of the Finance Commission should be enlarged considerably since it is a statutory body. This would reduce the interference of the center in the financial management of the states and the arbitrariness of discretionary grants that accompany such interference. In addition, it would reduce the atmosphere of suspicion and distrust in the states over the role of the center in federal finance system. There have been suggestions for establishment of an expert non-political agency by the central government to perform such functions as the Secretariat of the Commission is expected to perform. In addition, it can be entrusted to play a watching and advisory role with regard to center-state financial relations generally. The expert non-political agency can collect vital information regarding center-state finances to enable the Finance Commission, whenever appointed, to start work without loss of time. It can also oversee the implementation of the recommendations of the Finance Commission as accepted by the central government. Adequate steps should be undertaken to narrow down interstate disparities by adopting a set of criteria distinctly biased in favor of backward states, by giving more weightage to backwardness reflected through various economic and social indicators like per capita income, level of literacy, administrative services, hospitals, etc. In August 1980, the National Development Council accepted a modified Gudgill formula, raising the percentage of resources to be transferred to the states whose per capita income was less than the national average from 10% to 20%. Under the modified Gudgill formula, 60% of the assistance is to be given on the basis of population, 20% to the states having per capita income below the national average, 10% on basis of per capita tax effort, and 10% for special problems.
It is necessary to enlarge the very quantum of resources transferred from the center to the states. In this context, the proposal of Rajamanaj Committee to widen the base of devolution of resources to the states by including corporation tax, custom duties, and all excise duties in the divisible pool needs consideration. These taxes and duties are highly elastic and can help in considerably enlarging the revenue base of the states, which require more finance to fulfill the social and economic responsibilities which the development process is forcing them to undertake. Let us now summarize what we have learnt in this module. The Indian Constitution gives a detailed scheme of distribution of financial resources between the Union and the states. Both the Union government and the states have been provided with independent sources of revenue. One of the instruments which the Constitution has evolved for the purpose of distributing financial resources between the center and the states is the Finance Commission. According to Finance Commission, allocation of resources between center and states takes places in three ways as share in taxes and duties, grants and aid and loans. In addition to transfer of resources from the center to the states, according to the recommendation of the Finance Commission, there are two other sources of transfer, namely assistance for planning purposes from the Planning Commission and discretionary grants from the center to the states. Problems arise due to the imbalance of financial resources between the center and the states. Fiscal transfers through the Finance Commission and plan allocations through the Planning Commission have increased rather than narrowing down regional imbalances. Adequate steps should be undertaken to narrow down interstate disparities by adopting a set of criteria distinctly biased in favor of backward states by giving more weightage to the backwardness reflected through various socio-economic indicators. In the context of resource mobilization, the tax structure needs to be rationalized and tax evasion and other loopholes need to be plugged.